Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about the statement of cash flows, what it is, why it's important, what FASB hopes that we'll get out of the statement, what investors really get out of the statement, and the difference between the simplified version we've done in the past and the actual methods that are used by real companies. After we talked about all those conceptual details, we started doing an example, walking through 8 steps that allow us to create a statement of cash flows. And so far, we're almost done with step 3. We've talked about step 1, calculating a net change in cash for the year as a check figure. We've done step 2, creating our worksheets, and we're almost done with step 3, accounting for the special transactions that we made note of all year long, so that when we got to the statement of cash flows, we would know what we needed to look for. So now we need to finish up that 3rd step and move on to step 4 so that we can continue this process. And our next to last special transaction is this one. The company has a pension plan. Pension expense was $24,000 for the year. Our contribution to the plan was $18,000. So first off, is this operating, investing, or financing? Well, we know there's a cash flow here because we contributed money to the plan. So there is a cash flow. Pensions are not investing activities because they don't grow the business. They don't deal with long-term assets, at least not long-term assets that we use. They're long-term assets that belong to the pension plan, but that doesn't really help us. And it has nothing to do with my owners or investors. So I guess it must be operating by default. It's also operating because pensions are part of paying my employees and salaries are day-to-day activities. They're part of operating my business. So it is an operating activity. Our cash effect is the $18,000 that we actually contributed. Now we need to know the balance sheet effects. And again, the best way to figure out the balance sheet effects is to look at the journal entry. Yes, we love journal entries. Let's take a look at the journal entry for our pension. We know some of these numbers because they're given to us. It tells us pension expense right here in our description. We could also find it in the income statement, but since it's given to us, we'll just use it. And we know the cash amount, again, because it was given to us. Now we need to know what other accounts are involved. And we know from what we've already talked about pensions that there are 3 possible line items. There's other comprehensive income, prior service cost, other comprehensive income, actuarial gains and losses, and then the net pension obligation. The only way to figure out which accounts are involved is to go to our balance sheet and see which of those 3 accounts are there. So we're looking at our long-term liabilities and net pension obligation jumps out at me. It's right there. We go from $40,000 to $30,000. Let's see, it's a pension obligation, so it's a liability. If a liability goes from 40 to 30, that's a decrease in the liability. A decrease in a liability is a debit. So let's go ahead and put a debit into our transaction of $10,000. That takes care of that account. Now let's go see about the other 2 possible accounts. That's the OCI prior service cost and the OCI actuarial gains and losses. Other comprehensive income shows up in stockholders' equity, so we're going to jump right down here. And sure enough, the company has 2 OCI accounts. One of them is for my available for sale securities. So that's that market value adjustment for available for sale securities. The other has to do with my pensions. And lucky me, there's only 1 account. So even if they have both the prior service cost and the actuarial gains and losses, I only have to worry about 1 for what I'm doing right now, because all I can use is the information they give me in the balance sheet. I can't go back and find my actual pension entry, which granted, if I was doing this for a real company, I would do just to make sure I was good to go. But in this case, I know that my pension related other comprehensive income starts at $78,000. Let's see, it must be a debit in a credit section because it's listed as negative. That's the only time we see negatives on the balance sheet is if it has the opposite sign of what you'd expect in that section. So I expect credits. This is a negative, so it must be a debit of 78. I'm going from a debit of 78 to a debit of 62. That's a decrease of $16,000. If I want my debits to decrease by $16,000, I must have credited the account by $16,000. So accumulated OCI, pension related, credit of $16,000. And I'm going to stop right here and check. I've found everything that I can think of that's related to pensions. If there's nothing else involved in pensions, then this will balance. If not, I need to dig a little deeper and see if I can find other pension information. So let's just take a quick look. 24 plus 10 is 34,000. 16 plus 18, also 34,000. I've got it. This is everything related to the pension, and I've taken care of it. So with that, I know what my balance sheet effects are. I know I have a decrease in net pension obligation of 10,000. And I know I have an increase in accumulated OCI pension related 16,000. I call that an increase. The debit got smaller, which when you're talking about an account that's supposed to be an equity account, that means I'm moving closer to the credit side. So I treat that as an increase because I'm moving more towards the credits where I hope it will be. Well, now that I know the cash effect and the balance sheet effect, I can put it in my worksheet. Now, this doesn't go in investing or financing where I would just show cash paid for pensions, $18,000. Instead, it goes up in operating, and in operating, I need a different kind of adjustment. I need an adjustment that takes me from the accrual number to the cash number. And that means I need my shortcut again. So I'm going to scroll up here. My GAAP number is pension expense, and it's a negative 24,000. My cash number is 18,000. So if I want to go from GAAP to cash, I need an increase of $6,000. And that's what's going to go over here across from my pension expense. We're going to call this pension plan contributions. That's the conventional title for this. And it's going to be a positive $6,000. Now, again, we'll finish off this worksheet in step 6, but let's just show how this works. I take the negative 24 plus that 6,000. There's the 18,000 I actually contributed, and I'm going to call that cash paid for pension. You could also call it cash contributed to pension, but we're going to stick with this one. All right, that takes care of our pension adjustment, and hopefully it makes sense. The adjustment up in the operating section is to get from GAAP to cash so that I can account for the actual cash I paid, not what I recorded as the GAAP expense. I also have taken care of the balance sheet accounts, so I'm good to go with this transaction. Our last special transaction is a capital lease. We signed this capital lease on July 15th of year 6. That's my anniversary, by the way. I probably mentioned that in earlier videos, but I keep using that date in different examples in my classes so that I make sure I remember it. At least a couple of times a semester, I will do this example and go, oh yeah, that's my anniversary. Don't forget it. We like being married. It's a good thing to remember that number, or date, I guess, in this case. The present value of the new lease was $648,000. We want to know if there's a cash flow effect. And the answer is, I don't know yet. The only way to know is to figure out if I made a payment on my capital lease. And the only way to know that is to look at the balance in my capital lease account. So just like we did with dividends payable, I need to start by looking at my T account for lease obligations. That's what this company calls it. So I'm going to make my T account here. And if we go to our balance sheet, lease obligations started at $1,825,000 and ended at $2,108,000. So 1,825 ended at 2,108. Make that an ending balance here. There we go. And the other thing I know about my lease is that I created a new lease of $648,000, and the journal entry would have been a debit to PP&E of some kind, and I would have a credit to lease obligation. So that tells me two things. It tells me that there's a balance sheet effect here, an increase to, and let's see, to figure out what it's to, I need to go to my balance sheet, and I'll look at my total assets, and I do not have a leased assets, which means I must have put it in to land, building, and equipment because there's nowhere else for it to go. So land, building, and equipment is going to go up by $648,000, and that would be my debit. So my credit would be to this lease obligation, and now I can figure out if I made any payments because the payments would reduce the lease obligation. So 185 plus 648 minus the 2102 Sure enough, I have made some payments. This is my negative. Again, I have to say that it's a negative because I can't show negative in a T account. Never show negative in a T account. So now I know my cash effect. I know my balance sheet effect, both for the increase to land, building, and equipment, and also the T account for lease obligation. So I know I've accounted for everything with the lease obligation. Won't have to worry about that when I get to step 5. The only thing I'm missing is where does this go? Operating, investing, or financing? Well, we treat a lease as a loan. That's why it's a lease obligation. If I'm accounting for financing of an asset, even if it's through a lease, it's still financing. And that's where it's going to go on my statement of cash flows. So I'm going to have cash paid on capital lease as an outflow in my financing activities. And with that, I finally finished all my specialized transactions. What's fun about these transactions is I get to go back and do journal entries and figure out what's going on in balance sheet accounts and digging deep to know what's really going on. The alternative, of course, is as an accountant, as I'm going through and accounting for these transactions in the first place, I make some notes to myself so that when I do the statement of cash flows, I already know what I'm doing. But for our purposes right now, it's more fun to be able to dig through them a little bit. Now, I had hoped in this segment to finish step 3 and jump right into step 4 and get that done too, but I think we've probably gone far enough. We could all use a bit of a break. So stretch your legs, get some air. When we come back, we'll move out of step 3 and into step 4 as we continue building the statement of cash flows. So, like I said, we'll take a bit of a break and I'll see you in a minute.